So the story that, for those listeners who are interested, that I told Tom, that I've told it privately, but haven't told it publicly in this kind of forum. So, and I'm really happy to do it, is the story of my experience with Laboratory Corporations of America. This all happened in the early 2000s. So there I was. I'd actually had the opportunity to shake hands with Lou Simpson, who was one of Warren Buffett's lieutenants, an extremely talented and capable investor who suddenly a new position appears in his portfolio, a company called Laboratory Corporation of America. And this was a merger between a company called Bioreference Labs, which was partly owned by Roche in Switzerland, and National Health Labs, which was an American company. And this was the future of lab testing, blood lab testing, was high capital expenditures, but many, many tests, which would be very expensive and only capable of being done by the largest, most capitalized labs. And so this was clearly going to be one of the winners in a consolidating industry. And there was potentially one competitor emerging, and they'd taken a certain amount of debt to do the merger, and there was years of endless growth ahead of them. And then they had what I remember as a technical default on their debt, and the share price rapidly dropped from $8 a share approximately, which is where I had bought it, to $2 a share. And so at that point, so far so good, because that is just the normal course of business in the stock market. Things happen. Things don't always turn out the way you expect them to. The last 5 or 6 years has been a very unusual period. And again, that's where the rubber hits the road. And for the benefit of the viewer, I made a number of really big mistakes, or a number of errors that I would prefer not to have made. So first of all, nothing other than a quotational loss. And you're talking about 75% loss on my purchase, which is about what some people have in some of their SaaS tech businesses. And but nothing else had happened. Nobody was yelling, "You idiot!" Nobody was telling me to sell the shares. I don't know what would have happened when I reported to investors, if I would have gotten redemption requests or not. But at this point, none of that has happened. So a first mistake is that I went into a funk. All I could do was think about this company. I had other companies in my portfolio, but all I could do was think about this company and how much money I'd lost on a quotational loss. And in this case, the bankers were Credit Suisse, and they had a very close relationship with Roche. And they took a penalty from the company, and they modified the loan agreement. So it wasn't like the company was about to go into Chapter 11 or anything like that. It had a solid set of shareholders who were totally capable, if necessary, of recapitalizing the company, but that wasn't even necessary. They just needed a modification on one of the sort of covenants on the loan, as I remember. In any case, I couldn't think of anything else, and eventually the pressure came too great for me, and I sold the shares at $2 a share and felt so much better afterwards because the position was cleared out and I didn't have to think about it anymore. And that was that. And I tried to forget I ever owned it and tried to forget that I ever bought it. 5 or 6 years later, I discovered that Chieftain Capital Management owned shares of the company. I don't remember the name of the guy leading it, of kind of like buy and hold long-term investors. In any case, the results for the company were that it was more, from the $2 a share, it ended up at more than 100 or 200x, perhaps even more. It's too painful for me to do the study. The most profound fact about that is that if all I had done was done nothing, if I just held on to my shares at $8 a share, I would have made a lot more than 20 times my original investment. 20 times. My original analysis was right. All I had to do was sit there and do nothing, and I failed to do that. So in retrospect, did I pay too much for the company? Perhaps at that particular moment, and I bought into the flush of excitement at the merger and the fact that Lou Simpson had bought a bunch of shares, and I bought in the midst of enthusiasm. But then I doubled down on that mistake by selling it at the wrong time, and so I think that many investors right now are waking up to realize that they've made the mistake of overpaying. But I think that in many cases that I know of, they've actually bought into some extraordinary businesses. And what Charlie Munger says is that often the pain in the markets happen not because of a bad idea, but because of a good idea that was taken too far. And so many of these companies are extremely well managed. They have some super high quality people running them. They are not all of them, but some of them, and perhaps many of them, are extraordinarily good businesses. I believe that those people that I know who are invested in them have done good research, excellent research, beyond excellent research. And yes, perhaps they've paid too much for them, which is easy to see now. But it would be a great shame to compound that mistake by selling at the wrong time, if you like. And so that was a signal lesson to me. And perhaps that is helpful for some people who are sort of licking wounds right now.
If you enjoyed this clip, check out the full episode here and subscribe here. Thanks for watching.